Welcome to Investment 360. In the hot seat this evening, Keillen Ndlovu from Stanlib. Keillen, you've got your all-time fan here sitting, David Shapiro. Last time you mentioned Capital Property Fund, Mr. Shapiro went out the next day and bought it, and it's done very well for him, hasn't it?
For my clients, sure.
For your clients.
It's done well.
Yeah, it has done well. It's been touching all-time highs as well. In fact, it's one of the first property companies to touch all-time highs. It's trading at about 9.15. I think the last time we talked, it was trading at like 8.20, 8.30. So if you add the dividend as well,
that's history.
Yes. You've made,
so what should he be doing for his clients? What should he be doing for his clients going forward with Capital Property Fund?
Well, actually, it's run, yes, but there's still some legs in that counter. But there is actually better opportunities at this stage as well.
All right, well, you can't say better opportunities and then stop. We need to know where those better opportunities are in terms of deploying money.
And the one that we like at this stage is Vukile Properties, which we mentioned last time as well. It's trading at a yield of about 8.8%. The market is at just under 8%. So it's offering growth of about 6-7%. So it hasn't really run compared to some of the other counters. So we like Vukile as well. And some of the other counters you look at is some of the new listings, actually. They're trading at 9.5% forward yield, some as much as 10%. Vunani is at 10% forward yield.
So Vukile, Vunani,
yes.
Anything else on your radar screen?
I'll probably say Dipula A and Synergy A at a 9.5% yield. So like kind of guaranteed growth of 5%. But the new listings that we watch out for they're not as liquid as some of the new counters.
Well, that doesn't matter as long as you believe that the profits are sustainable, or the your rates, your interest, or sorry, what's it, rental? It's, your payments are sustainable, as well as that there's reasonable growth. I'm not looking for capital growth.
Yes, you're looking for income.
I'm
so
just looking for income.
Right,
I don't. In this kind of market, in this year, I think we're just looking for capital protection and a very good yield.
Okay, so you're in the right space in property. Yield 7.9 thereabout. It's fairly in line with the bond market, but you're getting growth of looking at about 5% income growth in the next 12 months. It's not a very exact number, but it's decent in the current economy.
And that goes to, if we look at the South African property index at the moment, it also hit a new record today, correctly.
Yes,
so it's working in line with the broader JSE all-share asset classes across the board rallying. But you do think it's fair value at these levels?
I think it is, especially like look at the yield as well. Like if you're getting 7.9, 8% yield, it's in line with the bond market. And on top of that, you're getting income growth. We're looking at 5% income growth in the next 12 months. Bonds will give you 7.9. That income doesn't grow. Put your money in cash, you'll be lucky to get 6% as an individual, and cash doesn't grow as well. So property, in terms of income,
in the sector, what must we watch out for? I mean, I know it's a very general question, but where are the potholes in the road in the sector?
The concerns around operating costs, increase in operating costs. That's electricity, your water, rates and taxes. So you're seeing actually cost rising in double-digit numbers. So it becomes difficult for...
Vacancies?
Vacancies, it depends on the sectors. The office market 2012 is still going to be tough, particularly in the B grade office space.
I was going to say, we need to break it down into A grade versus B grade.
That's right, yeah.
A grade is still doing very well.
Yeah, A grade is holding up nicely. There's still demand in that space. Good example is Cycom. They're still seeing vacancies going down in this market. But look at companies like Emira. Their vacancies are actually more than 22% now, because they're exposed to the secondary property market in the office space.
One of the biggest trends in 2011 was the fact that 15.5 billion rands worth of new property stock came into being. Do you think that momentum can continue, or are we now going to see a pause?
Well, it's going to slow down, but what we've seen is quite positive in that there's quite a huge amount, increase in size, liquidity, choice as well. So those companies that listed in 2011, they're looking to grow their portfolios. We've seen Vunani making announcements on looking at acquisition, Rebosses, Investec, Dipula as well. So they're going to fund that with both equity and debt. So if it's equity, that increases the market cap as well. So you could see a couple of billions, but not as much as last year.
And we were discussing in the previous sector the retail sales, and I mean the incredible growth that we see. Will this come through? Can this come through into certain property trusts that are exposed to it? Are they likely to surprise on the upside? Yeah,
we're seeing that actually in some of the retail-focused counters in the property space, where turnover growth is quite strong, more in line with the retail sales, like 7-10%. In some instances, quite strong, especially in the townships, where you're seeing strong actually growth in trading densities. In fact, township shopping centers actually are trading bigger shopping centers in the metropolitan areas.
Which one would you go for? I mean, which one's likely to benefit?
The one that
are you exposed to any?
Vugile is a good example as well.
Okay,
they've
Vugile,
got shopping centers in Soweto, Dobsonville. They've got some in Davidton as well in East Rand. So that market is doing phenomenally well.
There was a trend at the end of last year that we spoke about extensively, and that was the facelifts that many shopping centres were requiring in and out the metropolitan areas. Do you think that's another trend that we're going to see continuing into 2012?
Yeah, sure, yeah, definitely. So we're seeing, yes, it varies depending from companies. There are more active companies as well looking for opportunities, well, everywhere. And like companies like Resilient is a good example. They're playing in the dominant non-metropolitan space, and they're increasing their exposure there as well.
Offshore?
Offshore is quite an interesting one. I was in Hong Kong 2 days ago at an Asian property conference. Offshore markets actually looking more attractive relative to the local market. If you look at the valuations, deep discounts to NAV, 30–40% discounts to NAV. I find that the gap between where they're trading at like 5–6% forward yields compared to global bond yields at 2–3%. That's
but where specifically?
Where would we are?
Hong Kong. We like Hong Kong. There's some counters they're trading at 7–8% forward yields compared to low bond rates. 30–40% discounts to NAV. So Hong Kong we like a lot. We like Singapore. So we actually like Asia more than Europe. The growth there is actually amazing. When I went to Hong Kong, I couldn't believe some of the stores like your.
Can you get access? I mean, is there any way one can access it here? Or
yes, actually through our global property fund, we've got. It actually did well last year, delivered about 22% returns. But most of that was because...
A bigger fan. I see he's now been converted into a bigger fan.
Okay, we've got to take the rand out. We want to look at the real underlying.
Yeah. Actually, if you look at that, the market didn't really move that much last year. And there's still opportunities actually been going forward. Because if you're trading at 30–40% discounts to NAV, some of these counters, that's quite nice. US market, 4% yields thereabout.
You've spoken about Vunani, Vukile, the smaller players in the listed property environment. What about the majors? How are you feeling about them at the moment?
The majors, some of them have run, but it's about quality. Growth Point is trading at all-time highs, trading around 20 Rand thereabout. Resilient is run, Hyprop is run. But in this kind of economy, we want to be safe, play the prime space rather than secondary market. So it's too early to jump too much into the secondary property space. So Hyprop's big dominant shopping centers trading at about 7% forward yield, Resilient around 7%, Growth Point around 7%. But you can sleep at night when you've got counters like that. I
was chatting to Keillen Ndlovu, the CIO of Investment Solutions, earlier this week. And one of his key themes was diversification across portfolios, across asset classes, so that you would have elements of property, you would have elements of gold, you would have your bonds, you would have etc., etc. What exposure do you deem fair to listed property?
Even under Regulation 28, I think you can go up to 15%.
Would you max out on it?
It depends. I handle private client money, so it depends on yield. I still think it's a sector that has served the public, the man in the street, incredibly well in terms of the yields that you can get and also the growth. So if I'm looking for yield, it's a sector that I can go up to anywhere 10, 15, 20%, sure.
It was again the best performing asset class of 2011. So you could go up to 10, 12, 11%.
If you're growth orientated, no. And also the only drawback is that you're taxed on your yield. So if you're getting 8%, you're paying 40% tax, it comes down to 4.8% yield.
That's a big drawback here.
I'm talking about private, so where we're concerned. So that's my only drawback that I have. And I would rather probably look for a dividend yielder or something like that. But if the person hasn't got it, or if it's an institution, I mean, it's been a super sector.
Yeah. Well, actually, I think to point out as well, even after tax, still beats most of the equity companies.
Yeah.
And one thing as well, property companies pay out all their profits to investors. Whereas equity companies, you can look at that yield, but that company can change the dividend policy.
And the other point is our property companies are very well run.
Yes.
I think it's a sector where you can't fault anyone. Occasionally one might go off the rails or something, but we haven't seen any major failures. Companies today, you can virtually choose, even if the yields are slightly different, and we're discussing the best of the, the best of the breed. But overall, it's been a sector that is very, very well run.
Do you agree with those sentiments?
I fully agree as well. Even
because we have to discuss talking your book.
Yeah, no, actually, offshore players actually agree to that as well. And if you look at South Africa, held up in 2008, 2009, didn't have high gearing, and all these companies paid out rental income and annuity income. Whereas in the offshore space, some of them are desperate to boost their income growth and then paid out trading profits, fees, and all that. So that's why South Africa is one of the best.
Let's throw in their cap shop. What do you think of that counter?
Capital shopping centres, the UK economy is not actually in good shape at this stage. They've got,
but they pride themselves on those blue chip, if I can call, shopping centres, high end. Is that not going to be defensive?
So it will be, relatively speaking, but the prospects are not as exciting as some of the areas, like as mentioned, Asia. So the rental growth there, not exciting. Consumer there, not in good shape. But as a proxy for retail, then that's probably the best play they can play in. But there's actually better opportunities there.
Keillen, thanks for sharing your insights this evening. Keillen Ndlovu from Stanlib.